because it's such a delight and honor to be here. Welcome. And we are well aware, I believe we are the last thing sitting between everybody and lunch. So we'll make this enthusiastic and we'll be very efficient with the time. Wanted to jump right in. What a wonderful panel. Let me start over again. I'm Vince Molinari, founder and CEO of Fintech TV, and again, an absolute delight and honor to be moderating this panel with such an esteemed crew here today. Let's go right down. Arjun Sethi, who's the co-founder and CEO of Tribe Capital. We have John Medved, who is the founder and CEO of Our Crowd, and Sonia Gokhale. Got that right?
Yes, it did.
Thank you, Sonia. Of Venture Souk. Just gonna have everybody take a quick 30 seconds and introduce themselves, give a little foundation, and we'll jump right in. Arjun.
Based out of San Francisco and New York, about $1.5 billion in AUM, pretty generalist. We're mostly considered a technology, data-driven quant venture capital deployment, and then at the same time I run a blockchain company called Nibiru.
Great. Thank you, John.
I'm John Medved. I'm the founder and CEO of Our Crowd. We're one of the largest online venture investing platforms. We're based in Israel. We now have offices here in Abu Dhabi, and we're planning all kinds of great things for this market. We represent about 220,000 global investors, managing about $2 billion in assets, and have almost 400 portfolio companies and 40 funds under our umbrella.
My name is Sonia Gokhale. I'm one of the founders and general partners of Venture Souk. Venture Souk is an Abu Dhabi-based VC. We are one of the first fintech funds in the region, first sector-specific funds and first fintech funds in the region. We launched our first fintech fund in September 2020, and now we have our second fintech fund.
Brilliant. Well, let's start right off. And we have this great question when we look at the opportunity for fintech startups, particularly from the lens of VCs. And I think we have such a great composition of global views here. Maybe I'll start off, Arjun. When we look at VC investing from your lens, I know quite a bit, as I looked at Tribe, really looking deep at analytics, modeling from a quantitative standpoint. Maybe you can share how do you take that approach, and where does that lead you when you look at opportunity?
Yeah, I mean, it's like a loaded question, but if you take a look at financial services, it's roughly 60 to 70% of the world's GDP. And then you sort of take a step back and you trace throughout and say, okay, how much of that has software enabled in it versus typical brick and mortar. In the Western countries, there's a lot more brick and mortar, and we're moving towards digital. In the emerging markets, so Latin America, Southeast Asia, sort of India more predominantly today, they're moving at a sort of a speed of light for access to capital. And the things that we take a look at, if we take a step back, don't think about financial services, just think about companies that have scaled over the last 20 years, so Google, Facebook, Airbnb, et cetera, and you take that to its logical extreme and think about all of the types of opportunities that have software proliferating into financial services. What you're really looking at is where in that stack is going to be the most opportunities. So in India specifically, we have about 10 to 20% of our capital into companies that are software, but it doesn't mean you're building software for banks. You're building software in order to enable capital access. So that's on the fintech side. So I look at Shopify as like a fintech company as well, because they're offering access to capital for merchants. They're shipping and logistics companies for e-commerce. So you kind of go down every single software stack that has some sort of vertical application, and then there's fintech enabled in it. The same way you would think about machine learning and AI, like financial services and ingrained in some specific way. That's on the typical, what I'd say, fintech 2.0. And then you think about crypto, there's these new financial rails that are being built, and how does that sort of interact with what I'd say, interest rate swaps or mortgage-backed securities or credit lending, whatever it might be. And those are also sort of being invented or sort of reinvented or rethought of, for enterprise and B2B style thinking.
I want to come back to that crypto point in a minute, given all that's going on. Sonia, talk to me a little bit about our earlier conversation. You talked about how supportive the government's being around fintech investment, What are you seeing, and how does that help formulate your strategy?
Yeah, in the last about a lot prior to COVID, and COVID has absolutely accelerated this, is we've seen fintech in the region kind of leapfrog forward. And there's many reasons for that, and a lot of it is because of the government support that they've had towards the fintechs in our ecosystem. We and this has helped us, especially because of our, we're a fintech specific fund. We've seen what happened before COVID and during COVID is a lot of developmental capital from the governments here in Abu Dhabi and in the region have trickled down into our ecosystem. And because of this, the quality of founders and the quality of companies that we've seen is 10x of what we've seen in the past. So if you're a great individual with a great idea or that has an entrepreneurial spirit, and you're sitting and you're working in a financial position or a bank job, you're more likely to leave that position if you know that there's funding for startups. And because that funding for startups has become much more available, the quality of those startups have increased. It's not the same difficulty as finding those first few checks as it was 3-4 years ago. So that alone has helped build this ecosystem in ways we hadn't imagined. And then also because of COVID, everything moving to digital has really helped accelerate that. Also, we've had the governments that have been helping build regulations around the fintechs and being on the forefront of that to help our fintechs grow and build here. So the support here has really helped build this ecosystem and has helped us help our fintech companies.
Terrific, thank you. John, we've known each other for a while, and going back to the early days in the U.S. of the Jobs Act and democratization of access to capital, what you've done at Our Crowd has really been just amazing in that growth. We talked a little bit about looking at the region here, sovereign wealth funds, very large pools of capital. Are you looking at democratizing access to capital in the same way when you're opening offices here?
Yeah, I think the opportunity here is absolutely spectacular. And in fact, I want to do a very unscientific survey of this audience. How many of you, by a show of hands, have ever made an investment as an angel in a tech company? Raise your hand. Okay, so it looks like, if I'm not mistaken, about 30%,
30-40%,
25% of this audience. This is a perfect audience, right? You're here at Abu Dhabi Finance Week. The fact that probably 3/4 of you have never written a check for a venture-backed company as an angel or whatnot is really indicative of a worldwide problem, which is that venture capital, which we all love and the people on this panel are practicing, has not changed itself as an asset class management tool really in 50 years. If you went back to guys like Arthur Rock and Fred Adler and the big old deans of this asset class, they'd feel very comfortable with the structure of today's venture capital. And yet there are almost $90 trillion of capital in individual hands that says, wait a minute, what am I, chopped liver? How come the returns, which we all know are outsized when done well, okay, are only available to the sovereigns or only available to the big institutions? What about the rest of us? And so it's both an opportunity to develop enormous amounts of new capital, but as well to provide returns to investors. But it goes beyond that, because when you properly manage an online platform, you can actually get value add in a way to the portfolio company by getting network effects that you've never been able to see before. So I think that in this part of the world, the potential is enormous. Everybody looks at the sovereigns here and they're spectacular. We all want to work with them. But what about all the family offices? What about all the wealthy individuals? Don't they want to develop and be part of this complete revolution that technology and financial technology represents? So I think there's huge upside here.
May I
Please,
add,
jump
may I
right in.
add to that a little? I think the angel network here is a very interesting one, interesting topic to discuss. There are, and it is part of the evolution of VentureSoup. We actually started as an angel network. And initially, it was myself and my partner, now partners, investing together into various opportunities. And then we started bringing more people in and more friends in, and that's how we eventually built VentureSoup. But we actually started as an angel network. And there's a lot of interest in this region. There are lots of pools of capital that are not being tapped. And this is how we build this ecosystem is by these angel checks. The new companies, the early stage companies, rely on these checks to help them build and help them grow amazing companies. So what we noticed was the issue early on here in the region is just the lack of knowledge and ability to understand how to invest in tech properly, how to build your portfolio, how to build a diversified portfolio. So we spend a lot of time with NYU Abu Dhabi building education programs for these angels and doing events for these angels. And the events that we do are not network events. We actually have people come in with notebooks and they sit there and they take notes and they really, it's an engaged audience that is looking to invest. So that's something that we should, as an ecosystem, and the startup ecosystem, especially in fintech too, is to try and engage these angels early on, because you're right, there are very large opportunities for them to make large gains now and to bring these returns into people outside of the institutional investors that have been benefiting for a while.
Well, I couldn't agree with that more, Sonia, when we talk about education, awareness, and demystifying new investment practices, particularly when we're talking about access to private securities or instruments that aren't readily available in part of our traditional trajectory. So education, awareness, certainly foremost. Arjun, maybe if it's not giving away secret sauce, I'd love to hear from everybody about this. When you look at whether it's a geography, whether it's a sector, the core question, what is a VC looking at today? And is it different today, perhaps, as we've looked at this, I think largely globally, massive reset in valuations? What's the VC to do today?
So I want to hit what they had mentioned about access to capital and democratization. I think I choose the other side, which is that I think concentration and constraints matter. I don't think that everyone in the world can invest in early stage startups. Like if you do the math, there's like 40 to 50,000 companies that get started a year. And out of that, 95% have an attrition rate. So why would you want to invest in an asset class? I wouldn't. And then the next stage is, okay, great, out of the top 10% that stick around, how do you assess the risk of those companies at that stage, and how do you assess the risk at each stage? And there's a certain expertise level for future of innovation and software and the types of companies that you're investing in. It's actually pretty constrained. There's a very small amount of people that can do it. So if you're like a doctor or like my uncle who says like I want to invest in this company, by the time they think about investing in a company, it's usually not a good idea, right? So crypto or speculation of tokens, or like when Robinhood was at like $30 billion in the private markets and everyone wanted access to it. The issue is that you don't have the same access to information because it's private. You don't have the ability to assess the risk of that asset because it's private. And then there's liquidity issues, which is because it's private, you're not able to get liquidity at the same rate that you have in the public markets, or frankly, in the crypto token markets. And so, when we think about expertises there, or even when we think about venture capital, I mean, our whole job from day one when we're investing in a company or we're partnering with any of the people around the table is to be long duration investors, right? So our funds are 14 years. It's 10 plus 2 plus 2. And you have management fee and carry on top of it. There's an incentive alignment to make sure that you can build craft in your firm. It doesn't mean that everyone's good at it, but the idea is that the top 25% of capital allocators can think about how to assess the risk at different stages of an opportunity, and then you can try to figure out where you concentrate your capital, whatever the portfolio might look like. And so it's actually, I would actually say it's extremely hard to make venture capital successful in certain areas where an ecosystem doesn't exist, right? So if you take a look at even the Middle East or Saudi or what they're trying to do today, it's been years in the making. It's been like 20, 30 years that they've been thinking about how do we sort of make it work. And then you take a look at India and China, they've been going through their own sort of maturations. And it's very hard. And the reason why that's the case is that you need a concentration of capital, you need a concentration of expertise, and then you need a concentration of talent to go to a very specific select set of companies. It's not 50 companies, it's not 500 companies, it's usually 5 to 10. So again, historically, you look at China, it's it's JD, it's Alibaba, it's Baidu, it's a set of folks that set the tone for the industry and then started going from there, including Tencent. In India, they went through 3 waves of failures and like total loss of capital for 20 years before you could sort of get to the next stage. And so when I think about the asset class of venture capital, I think of it as like there's a certain amount of inherent risk, and then at a certain stage it becomes a little bit less risky. But that's because the risk associated with investing in a company that's worth $500 million in EV is similar to when companies went public 20 years ago.
So I love when we have a panel that doesn't agree, and I know
Isn't
John's
that
going to have something to say,
wonderful?
and Sonia. So let's wind it up and jump right in.
Look, I mean, what you're describing is the world as it is. What I'm describing is the world as it's going to become. There's no way you're keeping them out of this asset class. It's not going to happen. And the idea is that basically no one's saying that these people are as good as you or other top venture managers. The idea is, why wouldn't you take a $50,000 investor into your fund? The reason is because you don't want the hassle. It's much easier for you to raise a 10 or 20 or $50 million LP check and you're done. Okay, and give me my money and let me go do my work. And I don't want to manage this headache. But that's why there are people like me, because I want the headache. And so we have 40 different funds, top tier, top decile performing funds where we take $50,000 of retail, if you will, but they're accredited or mass affluent money, and then we aggregate it and we write you a $30 or $40 million check. You never need to see them.
Sure.
We take care of that. So that is one model. But the other model...
I think my pushback there is that model has already existed for a long time, right? You have wealth managers, you have passive capital.
No, they're not in. You can't pick up a phone and call Morgan or Goldman and put 50 grand in a venture fund.
Sure.
It doesn't work that way. And it will work that way. What's happening, look at private equity. Every major private equity fund in the world is now going after direct investors, okay? Because they realize that there's so much money and this is the future. So it's going to happen, but we'll get back on a desk.
Wait, can we do a business deal here, maybe?
Sure.
I'm sure we will.
I think the issue is that you have a lot of folks, and I can't speak to your guys' business model, but as you mentioned, you have a lot of private equity that go out to retail, but the issue is that, sure, they won't be charging any carry, but they charge an exorbitant amount of fees, so that by the time you get a return profile, it ends up being less than the index, being less than the other asset classes that are in the liquid markets, right? So if I was to pair my capital with, should I just put it into an index, S&P 500 or NASDAQ versus one of the private equity funds, I would just choose this all day long.
Yeah, I mean, the reality is that on our platform, you don't pay a fund-to-funds override. In other words, I totally object to excessive fees. 3 and 30 should be outlawed. Okay, it's sort of a crime against nature, and therefore we charge 2 and 20. Okay, so that if we ever do a deal, God willing, inshallah, okay, it will be that people will be able to invest in your fund at 2 and 20. How I make that work, I'm happy to share with you.
I have to jump over to Sonia because
I'll add a little here. Like you were saying, that the issues. Your uncle, who's a doctor, who gets, people probably come up to him and say, "Can you invest in my company?" That's the knowledge part and the access part, and so that's why platforms like our crowd, like AngelList, are available to them to invest into companies that or been vetted to a certain degree. You still get to pick which companies you want to go into, and
But you take a look at AngelList and Republic, and I'm investors in both. They don't work, and the reason why they don't work is that you go for retail and then you go towards institutional very quickly because it's expensive. And then part of the issue is that again, liquidity, access to the information, how long it takes for that duration is sort of the issue. Again, I think this way to sort of think about it is
hold on one second. I think we're getting our cue. Are we? We're out of time.
We're out of time.
We're
Great.
We should
out of
take the
time.
show on the road.
All right,
Okay?
so
I think there's a lot to
selfless,
discuss here.
Self-promotion here. We're going to have to continue this conversation on Fintech TV. So we're going to do a special episode. We have to bring it. We've got pages of conversation here. So I'm sorry. That's all we have today, folks. It was great to get started here and have this conversation. Thank you all.
Thank you.